Thanks for tuning in to this broadcast of The Resilient Advisor. My name is Jay Coulter, and joining me for this episode is my regular guest and friend, Chris Versace, as we bring you the tactical market strategies here in this crazy environment. Today, we're sitting in the middle of April. There's been a lot going on. Chris, really appreciate you coming on to share your thoughts from a tactical perspective and a thematic perspective. But most of all, what I really respect is your understanding of the data. Tell me, what are you seeing right now?
Well, happy belated Easter to you, Jay. I hope you didn't kill yourself on chocolate and Peeps. So what are we seeing? I mean, let's talk about where we are. You said we're in the middle of April. We are at the mouth of the March quarter earnings season, which kicks off in earnest later this week. And even as we begin, we have over 100 reports coming at us, with it just growing and growing over the next several weeks in terms of volume. So where have we come from? Several weeks of lockdown, closures for companies, an increasing number of furloughs. We've seen that reflected in the data on the manufacturing side, as well as on jobless claims, which, the last 3 weeks have been simply horrific. And I think there's going to be more to go on that. And I think the April employment report, when we get it in early May, it's going to be another head shaker.
Chris, can we go a little deeper? Can we go a little deeper on that? Because a lot of listeners might not have historically paid attention to the employment report. What are your expectations? But more importantly, what should advisors be looking at?
Well, let's tear it down a little bit, shall we? So there's a lot of numbers inside those reports. Okay, you have the number of people who have jobs being created. You have the unemployment rate, right? You have the number of people falling out of the labor force. You have the work week. You have average weekly hourly earnings, and just all these different data streams. And what I would suggest is it's all going to be bad. No surprise, right? I mean, on Friday, there was news that Disney is going to furlough 43,000 Walt Disney workers, okay? And we continue to see more and more companies doing this. So it means that more people will be headed towards initial jobless claims. So I would expect that number to tick up. The issue with the unemployment report is the way and when it's calculated. And I know you know this, Jay, but for your listeners, it is not something that is tabulated all month long. There is a window of time during which the data is collected, and that tends to be around the middle of the month. So if you think about what we've seen over the last 4 weeks, the first 2 weeks of April, last 2 weeks of March, that is really when we've seen this huge tick up in weekly jobless claims. So that alone is reason to think that while the March employment report might have been somewhat better than expected because it wasn't as bad, the reality is the April one is going to be far more painful.
All right, so I did not know that. I did not know that piece of information. So what? Okay, let me make sure I understand. So they're going to calculate the unemployment rate based on the previous 4 weeks this week. So the beginning of the top.
It'll not this week. It'll be the 4 weeks, the middle 4 weeks, if you will, that roll up into the April employment report that we will get in 2.5 weeks. That first week of May.
Got it. Okay.
So, but. The point to make here is we're only now seeing the impact of the virus, the closures, and the furloughs in the data. Thus far, we've seen it really impacted in manufacturing because, we get the IHS market PMIs early in the month, right? And we also get the ISM manufacturing numbers early in the month. But the big question is, what about that 2/3 of the economy that is tied directly and indirectly to the consumer? Well, this week, we actually get the March retail sales report. And I think, just based on what we heard last week from McDonald's and Starbucks, it is not going to be a very pleasant report to digest. Particularly if you're department stores. I think grocery stores like Kroger's, for example, Sprout, farmers markets and the like, I think they'll be fine. But McDonald's last week came out and said that, our March same-store comps fell off a cliff, and the first quarter was negative. Why was it negative? All because of the last 3 weeks of March. Starbucks came out and said something very similar. El Pollo Loco came out and said something similar as well. So if you think about the shift in consumer behavior, where we haven't been in quite a formal lockdown as we've been and seen over in Europe, particularly Italy, as you know, with Lenore. But we have been self-cocooning, and that has cut out really going and spending, going to the mall, going to Ross stores, going to Dick's Sporting Goods, what have you. And the reality is, even if you wanted to, a lot of these places are closed. Even most restaurants are only getting by on either drive-through or curbside pickup. So, the numbers that we're going to get in this retail sales report are going to be very, very challenging. And I think we're going to hear a lot more about this during this upcoming earnings season, which is going to span the next, 3-4 weeks.
Let's go a little deeper on McDonald's if we can. So you said that same store sales were down. Is that the data point you have? Do you recall
Correct.
the actual percentage they were down?
I do not off the top of my head. When we write the daily markets note, there's so much data that we're kind of amassing every morning. I can tell you this, though, and this is true for both McDonald's and for Starbucks, January and February, before the impact was domestically felt of the coronavirus, their same-store comps were positive. So if you think about the impact of reversing the entire quarter based on a 3-week period, they had to fall extremely hard, most likely in the double digits, and that could be anywhere from the mid-teens to perhaps the low 20%, a low 20% handle.
And so for podcast listeners, they cannot see the chart that we have up now of McDonald's. What I really struggle to put together is the fact that you're talking about double-digit same-store sales being down. Stock's only down 6% year to date because of this market rally. What does the portfolio manager, what does a financial advisor do with that data?
Which data? The down 6% or the down comp stairs?
Yep. And I'm sorry, let me correct myself. That is a 1-year number. Let's go year to date. Year to date, they're down 8%. That's it.
Yeah, not much of a difference. But I think, and it's too bad that people can't see the chart, Jay, because what you have is a significant fall off coming into March. And then really around March 23rd or so, you really start to see the rebound. And I think what we're seeing here in this chart is the notion that in parts of Europe, we started to see a peak. Wuhan, China started to open up again. And, in the last 2 weeks or so, there's been some commentary about the slowing caseload in terms of new cases here in the U.S. and also some increasing conversation in the last week or so about perhaps reopening the economy on May 1. And we'll see how all that goes. But I think the reality is the market might be getting a little bit ahead of itself, and I don't think it's really prepared for the rash of uncertainty that it's going to hear over the next 3 weeks. And by uncertainty, I mean, as these companies report their quarterly results, odds are we're going to see the vast majority of them do what we saw over the last 2 weeks, which is companies have reported, and when it comes to their outlook, they don't issue it because they don't know.
Which makes your job harder. Let's look at some more charts here since we're
wow, thanks for that.
Which we have some other companies reporting this week. Let's talk about Carnival. Got a chart up here. Very, very painful year-to-date chart. What are your thoughts?
Yeah. Well, I think it's going to get worse. The CDC came out this morning and said that they are stopping all cruise sailings for the foreseeable future that could last at least 100 days. But they're really waiting for the federal note to come down that the pandemic is over. So, this is, you want to talk about unknown. How many boats are going to sail? When are they going to sail? How many people are they going to carry? I think the chart you're showing shows that they're down like 77% year to date. I'm not one to sit here and go, I could be bottoming out. As I look at the incremental data flow, it's not getting any better for this company or the other cruise lines.
Yeah, so they had the other dynamic too of, are they eligible for bailouts? And I haven't been following that story as closely the last couple of weeks. Do you have any color on that? Since they're not paying U.S. taxes, there was a movement to have them not be eligible for these bailout programs.
Correct. And I do not know the latest and greatest, as they say. I do know that there's been some chatter in the cruise area of perhaps some either private equity or some wealthy sovereign funds looking to diversify their portfolio. So there might be something there, but we will see. My ear to the ground says that private equity companies are trying to figure out what's going on with their portfolio companies first, and unless unless they have a distressed portfolio, it's going to be a little challenging for them to put money to work as quickly.
Yeah,
but we'll see.
Yep. So Tuesday, Johnson & Johnson is reporting. What are your thoughts on their numbers? What data we could glean from it, even if they are not giving us forward guidance?
Well, a couple things. If you think about their product offering, I think that they are going to see, much like we saw in Costco and, believe it or not, in Nautilus, a pull forward in sales as people are trying to get ahead of the expected lockdown. So I think that will be a positive. Perhaps there's an upside print there in their quarterly results from March. I think what people are going to hang on, though, is what are they seeing on the coronavirus vaccine front? The World Health Organization, or the WHO, said this morning that they're working with something like 70 companies, including J&J, on a vaccine, and they're in various stages of development. I think out of 70 of them, I think 3 are in human trials or about to go into human trials. I doubt that's going to be a lot of U.S. companies, but we're going to want to hear what J&J has to say on the prognosis and, more importantly, the timing of when we see any coronavirus launch and when it's available, in mass capacity. I say that, Jay, because there's a lot of chatter about the recovery of the domestic economy, and there's 2 schools of thought. One is, wow, the longer we go, the greater the pent-up demand, and when we're back, people will go out and spend. And I think there's some truth to that. On the other hand, there are restaurants, sporting events, going to the mall, all of those things where, it's not 1 to 10 people, it is a horde of people. So the question is whether or not people will embrace going back to those things, particularly sporting events, until a vaccine is in the market and in mass. And ESPN came out with an interesting poll that said people aren't going to do it. So I think it's really, what it says to me is that certain pockets will pick up once the virus starts to subside. Excuse me, all tongue-tied this morning. But I think other areas, yes, you will need to see a vaccine. Hence, let's hear what J&J has to say.
Well, here are my 2 thoughts on sporting events. Number 1, you have to have a job in order to be able to purchase the tickets to go to those sporting events, and go to the movies, etc. And secondly, I'm a diehard Tennessee Volunteer fan. You put 100,000 people in a stadium on a Saturday. I'm hard-pressed to think in August I'm going to take my kids and my wife and go and sit down with 100,000 of my closest friends and watch a football game. I could be wrong, but I'm with you. I think it'll take a little while.
Yeah,
so
we'll see.
Wednesday, both Goldman Sachs and Bank of America report. You and I talk about Goldman Sachs a lot, so let's take this to Bank of America. What are your thoughts on what we can extrapolate from that earnings report?
Well, let's think about where they make their money, right? So there's, Bank of America is a financial conglomerate. So I think there are 3 things that we're going to have to pay attention to. One is, or 4 actually, now that I think of it. 1, loan demand. What are we seeing? What are they writing? More importantly, are they tightening their standards? And that's something that JP Morgan was talking about late last week that could inhibit loan growth near term. Second, we know the Fed has pulled out not a big bazooka, several bazookas, Jay. So what is the impact of that going to be on their business and their outlook? Traditionally, people are going to want to look at net interest margin. Well, with the Fed cutting rates, that is going to really weigh on their business. Third, what are they seeing in terms of credit cards, not just in terms of transaction volume, but potential delinquencies, given, as we've talked about over the last month, people losing their jobs or being furloughed. What is their ability to deal with that? So we're going to want to watch several credit card and other debt-facing metrics. And then fourth, near and dear to a lot of people's hearts in the financial markets is M&A activity, IPOs, secondaries. Have you seen any of those lately, Jay?
I don't think they've really shown up on the calendar yet.
Yeah. As I can tell you, because we include those in the daily markets note, the answer is no, we haven't seen any. So, Bank of America, JP Morgan, some of the larger banks, they have, a very diversified business mix. So, those comments that we get on those 4 points, you're really going to want to dig into, for example, community banks, what's going on with their loan profile. The credit card comments might spill over into some things that we can learn about for Visa, MasterCard, maybe American Express, although their business is largely fee-based, believe it or not. And then on the investment banking, we're going to want to look to those boutique banks that really focus either on M&A or do offerings.
So on Thursday, a friend of mine who is an officer at a local bank here in Georgia is going to come on the podcast, and we're going to talk about the PPP program, what you should do if you haven't already started taking steps, some of the implications there. What is the implication, to the best you can tell at this stage of the PPP, on the bigger banks like Bank of America?
I'm going to disappoint you, Jay, because I usually like to have an answer at the ready, but I do not have an answer for that. I'm kind of waiting and seeing. In fact, it probably means that I'll be tuning into your podcast to find out.
I love the honesty, man. All right, so another earnings release on Wednesday, I believe, is Las Vegas Sands. Please correct me if I'm wrong. Looking at Sands year to date, it's down 32%, in line with the market. Not more than I'm sorry, it's not in line with the market anymore, but it's
not anymore,
precipitously more than the market. But in relative terms, not completely decimated like the cruise ships. What are your thoughts on the casino industry?
So if you think about the casinos, right, so there's really 2 parts to focus in on, right? There's Las Vegas, which is, we've seen the shutdowns roll through of late, but there's also Macau, which took it on the chin February and March. And as China reopens, the thought is that Macau will start to reopen. So the positive is that Macau reports monthly data. So we're going to want to watch and see if there's a pickup again in early May for the April data month over month. I could tell you that the March data was horrible. The February data was horrible as well. So I think what we're seeing in the slight rebound that we see in this chart here is people are anticipating Macau coming back while we wait and see what happens with Las Vegas. Again, going back to your conversation about you and your best 100,000 friends there, when you go to Vegas, tends to be crowded, tends to be a lot of gaming on the floor, attendance at shows, that sort of thing. I would be a little skeptical on how quickly that business comes back. Will it come back eventually? Odds are it will. I think it's going to take time.
Yeah, I'm with you. It'll definitely come back because gamblers like to gamble, but those gamblers also need jobs and income to be able to support going out there.
I appreciate what you keep coming back to, Jay. So it's kind of like a catch-22 here, right? So, not only is it people having money to spend, but are the casinos open? Can they bring people back so they can really reopen different parts of the casino? So it's it's chicken and the egg.
Yeah. Yep. All right. Also on Thursday, BlackRock is going to report. So they're in a fairly unique situation in that they are helping the Federal Reserve buy ETFs. They have a great lens into the whole economy because of all the products that they produce. What do you think we're going to be able to glean from their earnings report?
Well, I think it's going to come down to what can they say about what they're doing with the Fed. Right. I think the other part to watch is what's the flow in between their funds. Are people cycling out of equities? Are they in cash? Are they, was that at the end of March? What have they seen April to date? Are people sliding back into the market, buying along with the rebound that we've seen over the last 2 weeks? The other question is, is it equities? Is it fixed income? Because as you know, fixed income is taking it on the chin and is looking a little ugly. What do they see for that in terms of flows? So those are the things that I'll be listening for.
And so historically, I've never listened to a BlackRock earnings call. Do they give that type of information with some forward-looking guidance?
Generally speaking, They give some, to use the expression, they do show a little vague. I don't believe, to continue with that, I don't believe they go above the kneecap. So, but, look, these are unprecedented times, no playbook, yada, yada, yada. So we will see what they say, and then we'll have to, piece it all together as best we can as all these other financial institutions report.
Well, that seems like an earnings call that might be worth tuning into, just given their view into the economy.
I look forward to talking with you next Monday and getting your 3-bullet takeaway, Jay.
Last chart, last stock. Good old Atlanta-based company, Delta Airlines. They've been utterly pummeled with the rest of the airline stocks. What does it look like for Delta?
Can I use my clever Lang in Mr. T impression?
That's why I love you. Please.
What's my prediction? My prediction is pain. No, I mean, look, in all seriousness, the airline industry has been battered. And I think there hasn't been a week that had gone by where we haven't heard of something relating to the airlines, more on the negative than the positive. And by that, I mean, whether it's the number of flights that have been canceled, how long they will have canceled these flights. And it's not just here in the U.S. So that would be your JetBlue, your United, American Airlines, and Delta, of course, but others around the globe as well. And, there's some statistics out there that really kind of, put this, frame this well, if you will. This time last year, it's either United or JetBlue, or maybe even Delta. At this point, I can't even keep it straight. But flying in and out of LaGuardia Airport in New York, which is one of the busier airports, they're running 7 flights a day. That is down from 157 flights this time a year ago per day.
Wow.
Per day. Now, think about that. Think about the impact of people trying to rescind all the trips that they have booked already. There's some chatter inside of DC that they might have to actually give back funds, not give credits. That would be a big deal.
Mm-hmm.
So this is another one just filled with uncertainty. And the thing is, if you go into the Wayback Machine with me, Jay, because I know I'm sure you were around for this just like I was. After 9/11, there was a lot of talk that, no one's going to travel ever again. But over time, we did, whether it was for work, whether it's for vacation, what have you. But what's interesting now compared to then is the technology that we have, the broadband that we have, the video streaming capabilities we have, like what we're doing right now. This to me says that there is a chance that business travel does not come back as quickly as it did last time. And I think the longer that the current self-cocooning, lockdown, whatever you want to use here in the States happens, businesses are adapting. And I think if we do it for 4 weeks, 8 weeks, in Virginia, where we're supposedly closed through June 10th, which means it'll be somewhere like 10, 12 weeks when this is all over, companies will have enough data, almost a quarter full, to assess the impact on their business and their travel expenses. So I'm very curious to see what the airlines have to say about the outlook for business travel.
So along those same lines, and I'm very careful to not talk about my consulting business on these podcasts, but this is
consulting business.
This is a great data point. So I have had no less than 5 financial advisors working inside of wirehouses reach out to me, and I don't do any recruiting, asking how they can now become independent financial advisors and what the process looks like. Because what they have learned is their clients do not care that they are working from their basement. Their clients do not care that they're not sitting in expensive Class A office space. They really don't care. So I think that dynamic is going to affect real estate.
Probably more than ever, what they're grateful for is the advisor who actually picked up the phone throughout this, and whether it called them once, twice, 3 times, whatever, and shared their perspective, probably soothed them a little bit, saying correctly, look, this is a speed bump. We don't know how big of a speed bump it is, but it's a speed bump. We will get through this, and if you're a long-term investor, the last thing you want to do now, when we were down, a couple of weeks ago around March 23rd, last thing you want to do now, unless you have to, unless your back is against the wall, the last thing you want to do is sell at these levels. That is a wonderful phone call, and, hard to make, but simply fantastic to hear on the receiving end.
Yeah, that's right. Chris, our time is up. I appreciate you coming on again. You're an absolute wealth of knowledge, especially as it comes around deciphering the data that we're seeing and then looking at some of these individual securities. Look forward to speaking with you again next week.
Thanks, Jay.